Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. It's the inaugural show, and I couldn't think of a better guest to have than Greg Willett. So, Greg, appreciate you joining us.
Thanks very much for the invitation, Mike. I'm glad to be here.
So those of you who don't know Greg Willett's the Chief Economist at RealPage. He's the guy that everyone in the business looks to for market information and kind of knowing what's going on. So I thought we'd just maybe have a quick little conversation today, kind of go through the state of the market. It's been a choppy year, I guess, that is, for lack of a better term, been up and down. And so maybe we kind of just start, Greg, what's kind of the state of the general market? Kind of maybe start from the 10,000 foot view and we kind of work our way down into Texas. But maybe some just general thoughts of kind of where we sit today.
The market is actually in surprisingly good shape, particularly if you go back to what was happening in March and April as what we were afraid might develop here as the year went along. But we're actually, for the U.S. as a whole, the occupancy number has barely come down from the year ago rate, and we were pretty much in line with an all-time high a year ago. So that has certainly helped. Rents a little bit pretty variable from one place to another. And we'll explore some of the overall markets. U.S. as a whole down a little bit, but there are certainly some places where you're getting some pretty good rent growth still.
Yeah, so for me, it kind of seems like what's the old Dickens book, Tale of Two Cities.
Tale of Two Cities. Yeah, I mean it is what we've seen all year long, and what we're talking about, our theme tends to be bifurcation.
Yeah.
And it just really is different from one place to another, and to some degree from one segment of the market to another.
Well, maybe let's start here. So like where were we kind of going into 2020, and now here we are kind of closing out 2020, going into 2021. What's really kind of changed from like occupancy metrics from a macro standpoint in the United States?
Yeah, we started from a good point on the occupancy side. Again, as I said, close to an all-time high. And I will point out, people were a little bit nervous about 2020, even pre-pandemic. They were playing defense and trying to get occupancy as high as they could because there was some fear of what would happen with the economy. It was already growth was beginning to slow down already. A lot of new supply was coming at us. So operators were really paying attention to those occupancy numbers, trying to get it as high as they could. And so that's given us some cushion. And so we've given up a little ground, but we're still at overall US occupancy is 95% and change. To give you some perspective, the last recession that we had, the great financial crisis, you got all the way down to occupancy of 92% or so. So we're way better than what we had seen previously. Rents, again, not great pricing power, but some places still have some pricing power and are getting a little bit of rent growth, although the overall number is down 1 to 2% year over year.
So you say that we're 95% from a nationwide from an occupancy standpoint. Well, how much of that is actually people that are in these units that aren't paying? So we have, maybe physical occupancy, but there's this economic vacancy that's baked in.
It's a great question, and something that obviously people were really concerned about as the pandemic hit. And so we are one of the companies that is participating in the National Multifamily Housing Council Rent Payment Tracker. We provide our data for that effort. And you look at those numbers overall, it's barely moved. The collections numbers for the U.S. as a whole are down 1 to 2% from where they were a year ago. But if you think about the size of the job loss, that's an incredible number. That reflects, number one, I'll circle back to the CARES Act that was put in place when the pandemic first emerged, and that really provided some enhanced unemployment benefits for folks who had lost their jobs. And so they were able to make the rent and actually save a little bit for moving forward. Those payments have stopped now. We need some additional efforts to keep people afloat. But for the most part, particularly in this professionally managed apartment segment, the payment numbers have been fine.
Yeah, and that's kind of what we've noticed across our portfolio. Certainly, our delinquency is up, but it's nothing that's not manageable. And a lot of the loans that we have are actually on adjustable rate mortgages. So now our interest rates have gone down because LIBOR, and now we're going to SOFR is basically next to zero. So we're actually probably making more money than ever before just because of the debt service savings. But kind of back to that tale of two markets or tale of two cities kind of concept. What are kind of like the on markets and what are kind of like the off markets? Because you hear the headlines, no one's going to live in the urban core anymore. Everything's terrible, and everyone's going to go to suburbia. Is that really what's playing out?
Certainly, the headlines a lot of times are blood in the streets, and they concentrate on what's happening in New York and San Francisco, and to some degree, that's a true story for New York and San Francisco. You've had occupancy drop sharply. You have people who are leaving the metro, those metros. They're bailing on the urban core in particular. So there is truth to that, but that is not what's happening in the country as a whole. And particularly the Sunbelt markets are holding up fairly well. You've still got strong demand in these Sunbelt markets. In the Midwest, slow and steady, but that's a great performance at this point when you compare it to some other places.
So New York, San Francisco, Chicago,
to some degree, LA, Seattle, Boston, and to some degree, Washington, D.C. Those are the struggling spots versus places that were doing well pre-pandemic are continuing to do well in terms of Texas, that Carolinas and Tennessee cluster of markets, Atlanta, Phoenix, Denver, those all look good. Maybe from the pre-pandemic best performers, those Florida markets have lost some momentum because they do have heavy hospitality economic bases. But most of the places that were doing well pre-pandemic are continuing to do reasonably well.
So urban, suburban, is that a myth too? Is that market by market, or is that a general blanket? No one's going to live in the urban core anymore. We're all going to the suburbs.
Yeah, that's extremely exaggerated, and particularly in the Sunbelt markets, the urban core, you still have positive demand for apartments in the urban core across the Sunbelt. It's not huge, and the performance is not where it was pre-pandemic. But we're here in Dallas. It's not the case that everybody is moving out of the uptown market and going to Frisco. That's just not happening.
So supply has been a big thing, certainly in Dallas-Fort Worth, which is where we're at, where you supply leader year over year over year. Seemingly they keep putting 25, 30,000 units a year, deliver every single year, and we keep seeming to think that supply might slow up at some point, and it never seems to.
It never really does.
Is that what's different like this cycle versus the Great Recession 12 years ago? We had big supply shock where the supply dropped dramatically. Is that what we're seeing coming in our future, or are we going to keep just building through this?
Well, nation as a whole, I mean, obviously it takes a while to deliver product from the time you start construction. So things that were started pre-pandemic, we've still got close to 600,000 market rate units that are under construction across the country and will deliver in the next 18 to 24 months. So, and it's in a lot of places, it's going to be tough to get those through initial lease up because while demand's there, it's not robust at this point. And so we think that the construction levels are going to pull back a little bit, but probably not a lot. And what's happening now is trades did not stop versus what happened in the last recession. And so some of this new product, particularly suburban product, is continuing to trade at the same prices that we're seeing pre-pandemic. And so developers are still making money flipping products. So unless somebody cuts off their supply of money, they're going to keep going.
Are we seeing some of the headlines that you read and you see is that we're seeing lumber, concrete, labor, all these materials, all the inputs into to building a multifamily project are going through the roof. Do you guys track that at RealPage? Is that going to have
We
some
pay
impact?
attention to those numbers. We're not producing those numbers ourselves. But yes, I mean, the costs of construction are certainly going up, and that's going to make fewer deals work than would have earlier. But I still think that we're going to get pretty substantial construction continuing.
Got it. And then kind of before we get into maybe a little bit more Texas centric, because that's where we're based here. But is there a big difference between like your different classes within multifamily? You got your A, your B, and your C. You also kind of have your towers, your mid rise, and your garden style product. Is there any one part of that the market performing a little bit better than the others? What kind of takeaways have we seen the last several months?
Certainly, the part that's struggling is the more expensive product. So that is urban core, that is the towers. So a weaker performance on both occupancy and on rents whenever you're talking about that product. To this point, the Class B product has held up really well and has the Class C. And Class C is maybe a little bit of a surprise there. Usually Class C struggles during a recession, but thus far holding up pretty well. And the term we're using is flight to affordability. And we're seeing people, even if you're renting right now and you could afford luxury a product, a lot of people are opting not to go that route, and they're saving some money on rent and renting the B or C units.
And when you say it's holding up well, B and C, that's from a physical occupancy standpoint and rental rates, both?
Well, and in terms of, we've certainly got rent cuts in the top tier Class A product virtually everywhere across the country. B tends to be close to zero. I mean, you can have some slight cuts in some places, but it's not extreme.
Yeah.
C tends to be basically flat. Our last set of numbers for the month of October, it was the first time that Class C product year over year rent change went slightly negative, but it's barely.
Okay, so my experience is we own everywhere from workforce housing to brand new Class A. Our delinquency, that to the extent that we have it a little bit more elevated, tends to be in the older, more workforce housing space. So I don't know if maybe that's not flowing through to some
Well,
of
no,
the.
that is true, but isn't that always the case, though? I mean,
It is.
yeah, yes, there's a little bit more delinquency at that bottom tier of the market, but it hasn't moved any differently than what we've seen at the top as well. I mean, they're moving at about the same level, but the payment level is lower in Class C product.
Fair enough. So maybe we talk a little bit about Texas because that's kind of where we're based, what we focus on. A lot of people that probably going to watch the show focus on too. Obviously Texas has been on market for what, decade or better at this point. Completely transformed after the Great Recession. Seen a lot of corporate reloads, population growth's been through the roof, and as we just mentioned, developers like to build apartments here. It kind of seems to be the center of the multifamily universe, pretty close to where we're recording this right now. Maybe kind of talk about Texas as a whole, and maybe kind of compare and contrast some of the four markets because you going into COVID, talking with you previously, and kind of what I've observed as well. You really had Dallas and Austin were kind of the two leaders. San Antonio's always been kind of slow and steady, and Houston's always been boom or bust with the energy. What's kind of happened the last 7-8 months now?
I think maybe just start out with the economies, and that Texas is doing a little bit better on recovery than most places. If you go back to that March and April timeframe for the U.S. as a whole, employment got cut around 13% just in those 2 months.
Oh, wow.
And so we've been filling in that hole. And for the U.S. as a whole, we're about halfway there. The Texas markets have tended to do better. The Austin and Dallas-Fort Worth the employment numbers are down about 4% relative to where we were in
So what
in
is that, like
February.
8% or so? And
So that means, and they had basically the same size drops as the U.S. as a whole. So we've gone from double-digit declines to now we're only about 4% behind in Austin and DFW, about 5% behind in San Antonio, and about 6% to 7% behind in Houston. It's a little bit more of a struggle in Houston, but that has, with better uh, economic comebacks here, the demand numbers have stayed pretty robust over the past few months in the Texas markets. So occupancy's in okay shape. I mean, it's not, Texas is never at the top of the list for
Sure.
occupancy because you've got so many properties that are going through initial lease up given
Sure.
all the construction. So occupancy's okay. And we look at rent growth. Um, Dallas and San Antonio are basically flat, moderate price cuts in Houston. I think year over year it's around -3%. The surprising one is Austin, which is really underperforming what you would expect to be happening given the nature of the economy there. We got rent cuts of about 5% in Austin.
Across the board?
Yeah, in Austin, and yeah, we're losing momentum really across all product classes there.
Is there, speaking of Austin, we own suburban Austin, both north and south, but we don't own the urban core. Is that a lot of that, you think, being driven by the urban core and all the big giant towers at $3, $4 in rents, with, a homeless problem that we have in Austin that you don't necessarily see as much in some of the other major metros in Texas?
I would say urban core in Austin struggling a little bit more than in the other Texas markets, but there's lots of construction in Austin in virtually every neighborhood,
Yeah.
and that's holding back the performances a little bit. So it's not just the urban core. There's just a little bit of general softness in Austin.
Austin has what, somewhere around 17,000 units under construction, something like that.
Yeah, it's a sizable block, and whenever you look in terms of the inventory growth rate for there, Austin is alongside places like Charlotte and Nashville as really the most aggressive pace of construction, although the absolute number is not as big as what you see in Dallas Fort Worth.
Because the base
obviously.
is something like 200,000 market rate apartment
Right,
units. So you're
right.
adding, 8-9% of the supply over the next 2 years, roughly. So that makes sense. So going back to maybe talk a little bit more about Houston first, and then maybe go to San Antonio. But Houston, boom bust oil. We have a little bit elevated vacancy there. Rents are down there. Do we see more concern for Houston, or do we think as soon as oil comes back, Houston's going to be right back and kind of be there? It seems like the supply numbers kind of tapered off in Houston as well.
Yeah, well, I mean, as soon as oil comes back, that's a dramatic statement there because does oil come back? I mean, our baseline forecast is kind of middle of the road on this one. We don't think the economy in the near term is particularly robust. It's done better than we would have expected thus far,
Yeah.
but it's not in great shape. And on the construction, it's not off the charts relative to what Houston does sometimes, but it is double what it was a couple of years ago. So, and it's still pretty concentrated in a handful of spots versus, and I'll do the contrast to Austin and DFW where there's construction everywhere. In Houston, it's just certain neighborhoods, and those neighborhoods are gonna struggle.
Yeah. Well, maybe let's go to San Antonio. That's always been the slow and steady, kind of boring, plodding market. My recollection is San Antonio certainly had quite a bit of supply delivered, in 16, 17, 18. Market seemed like it got a little bit soft. Has the supply tapered off? Is the market fundamentals improving? What's kind of your outlook going forward on that?
You're right on the supply number. I mean, that's the outlier for Texas, that the current construction volume in San Antonio is the smallest it's been in a decade. So that's going to help this one as we move ahead, and particularly some of those traditional performance leader neighborhoods in San Antonio, whenever you get out on the far northwest side of the market and on the west side, they really don't have anything under construction at this point. And so there's the potential for those areas to do pretty well.
Yeah, that makes sense. So then kind of coming back home, this Dallas Fort Worth is where I own most of the properties that we have today. We tend to be suburban, spread out all across the board. As you mentioned, it seems like we're building apartments everywhere. And, maybe 4 or 5 years ago, the headlines were just Frisco, Plano,
Right.
Frisco, and Uptown seemed to be where the supply was. What's kind of the story here for a supply story? And then kind of what do you see kind of Dallas Fort Worth playing out in 2021 kind of forward?
We're still building a lot, although it has scaled back a little bit. I think that the current numbers, we've got around 40,000 units under construction. A couple years ago, we were at 43, 44,000. So, I mean, it's off a little bit, but that's not exactly a huge pullback.
Sure.
So we continue to build. The most aggressive spots for building are the urban core and uh, Frisco, Allen, McKinney. But in those development hotspots, it's not quite the volume that it was a couple of years ago. So very active, but not quite as extreme. And, we are having construction pop up in places where we hadn't been building to date. And list, I was looking at the leading submarkets a few days ago for construction in Dallas Fort Worth. I can't remember when Haltom City would have been on that list,
Yeah.
maybe a place like Garland, or yes, Plano was on there, but it's East Plano.
Sure.
So a little bit of movement around, and we like that. I mean, that does help us to digest that product if we don't build it all in one
So,
place.
so you tell me all the easy sites are gone, and now they're going to second, third type of sites, or they're just kind of going away because they didn't get the developers to get the returns on their fifth deal in Frisco they developed. So maybe they're looking to a place that maybe doesn't have all the supply.
Well, yeah, I mean, I think it is. I mean, returns are decent, or you wouldn't keep building, but
Yeah.
they're certainly not where they were earlier in this cycle. And so that does make some places that you would not have built before are acceptable choices now.
So kind of just wrapping this part of the conversation up, but what do you see kind of 2021 going forward? It seems like you mentioned when we first started talking, there's quite a bit of capital out there. Seems like the sales are going. I'm just kind of looking around, kind of the day to day. We actually just bought a property today, this morning, and we were in a knife fight with a bunch of people,
Right.
and it's like the pricing is as expensive or more than what it was I'm at the beginning of 2020. And it seems like we're starting to see a lot of new market participants come in that weren't necessarily here a year ago. Coastal money coming in, people from other asset classes coming in. So kind of, do you have any do you guys track the cap rates, or do you have any sort of thoughts around kind of where you guys see the cap rates are today and kind of what that looks like going forward?
Yeah, I mean, and I'll echo everything you've just said. I mean, the capital is still there. It is coming in from the coastal markets. It's coming in from groups that had been investing in other real estate types. And so that is going to keep the pricing pretty hefty. And so we think the cap rates are probably going to stay about where they are, but I wouldn't rule out that you actually, in some of the suburban locations, you got a little bit more cap rate compression over the next year or two.
Yeah, I mean that would make sense. I mean, as long as unless you're going to tell me that JPAL is going to start raising interest rates, I don't see what's going to drive cap rates up, especially in suburban Texas markets. I mean, it seems like, or Arizona or Florida or some places like similar to
And
that.
and you mentioned that the low interest rates, and that's making these deals work, whereas they wouldn't if we were in a little bit more inflationary times.
So, do you guys have your base case kind of projections going forward? When do we kind of get back to quote unquote normal collections? When do you guys have any sort of sense of when we can actually start evicting people? Kind of get more to like a normalized market?
y- we think that what we're seeing now by and large holds really through most of next year. It's a little bit of a struggle, and then momentum returns whenever we get into 2022. And that's specifically for looking at most of the Texas markets and the Sunbelt area. I think it's a much harder call on when do these coastal markets really get going again, and how long will it take them to get that momentum established once more.
Yeah, and that's to me, you say that kind of reminds me of something I observed the other day. Like I was looking at what the cap rates on Manhattan Island are, and it's like right now, this moment in time, you could buy a property in Hearst, Texas, on a lower cap rate than what it would be in Manhattan
Right,
Island. And
right.
when the hell has that ever been a
Exactly.
thing? It's kind of a backwards world. I guess that's kind of the uncertainty of the political and business climate in some of these different markets makes it a little bit harder to go put your money into an environment like that.
And you mentioned the political climate. I mean, that does help Texas and the Sun Belt, whereas it's still who knows what the legislators
Yeah.
on the local and state level are going to do in some of these coastal spots.
Speaking of that political, I guess, do you have any thoughts on the pending change in administration? It seems like Biden's gonna be in there. Hopefully, by the time this is released, maybe we'll have a little bit more certainty to that. And it seems like the Republicans are likely to hold the Senate. Any thoughts on kind of what that would do to our industry?
I'll just circle back to the economy and the pandemic are two sides of the same coin. You can't fix one without fixing the other. And so certainly the assumption is that the Biden administration would be more proactive in trying to get a handle on what's happening with the health crisis. And so that is probably good for us in the big picture. If you have concerns about the Biden administration, it's some of the preferences that have been expressed on raising taxes and particularly for capital gains,
Yeah.
and let's get rid of the 1031 exchange program. But if you have the Republicans controlling the Senate, can you get those tax changes through? So from my perspective, I think the consensus that you would hear from a lot of economists is this was probably the best possible results.
Yeah, and I probably echo that too. And I do think if they are able to get rid of the 1031 or increase capital gains, you're probably just going to see transaction volume grind to a halt. Because I don't know what exactly the percentage of 1031 sellers are, but it's probably 25-30% of the
I mean,
marketplace.
it's significant. And yes, there will be a bump there. But also, what I would really say is what we really want is to get rid of the chaos and uncertainty. And if you change the rules and I don't like the rules, I'll still know what to do
Sure.
and can move forward. But if I don't know what the rules are, then that's a problem.
Yeah. So, any other things that you've kind of noticed now that we're in a little bit different world, a lot more remote? A lot of the functions that we were doing on site, some of those functions are now becoming off site on the property. You guys are RealPage or a technology company. You have how many lines of business?
We have a
120.
lot. We have a lot.
More than you can probably count, and you add them more and more by the day. I'm sure I probably pay for 4 or 5 of your guys' services in some form or fashion at minimum. Have you noticed any sort of changes to kind of from your view within the major technology provider for our industry? Anything kind of changed or different from a year ago?
I mean, the operations side of the business is very different from what it was, and I will say we were moving in a certain direction, and this really just accelerated things, and particularly just in terms of virtual leasing and operations, and that's pretty much a requirement now that you have those capabilities. You want to get people on automated payments. You want to really pay attention to the resident risk profile as you're doing some renting at this point, and pay attention to the things that can help manage your expenses because you've got a couple of things in property taxes and insurance that are out of control.
Yeah.
So you're looking at other things on the operations side of the business that maybe you can manage a little bit more proactively.
Have you, one thing I know that you're a big proponent on because we've had a conversation prior about it is revenue management. And anytime someone tells you, "Well, I want to deviate from revenue management," you'll probably say that revenue management is always going to be right because it's there for a reason. Have we noticed that change or that be effective or that's working? Any sort of comments around? You guys have both LRO and YieldStar within the family of products.
I mean, certainly the feedback that we're getting from our clients in this market disruption, they're still happy with the way these revenue management programs are working. And I will point out that we're really in the process of introducing a new generation of revenue management that has some artificial intelligence built into it, that we think it's even a better product than it was a couple of years ago.
What is that going to look like, or at least the headline version of that?
It takes you beyond just juggling occupancy and price, and brings into consideration your marketing efforts and some resident screening background products. So it just brings additional levers in there, and really at this point we're getting great results from the early adopters of this new generation.
That's neat. So anything else that you kind of thoughts on your mind before we kind of wrap up here? Any other kind of thoughts as we go into 2021, things that people should be paying attention to, or anything that you're particularly paying attention to, either from a market standpoint or a technology standpoint?
Certainly, I think the big picture is people are just relieved of, given where we are versus where we could have been at this point. And people are thinking about their strategies. What have we learned during the course of this? And also, something I would really encourage people to think about when they're considering strategies is understand what you actually do well.
Yeah.
So
Yeah.
if the market is telling you to go in a certain direction, but you don't know how to do that, then that's probably not the route that you should go.
Yeah. Well, good. Well, Greg, definitely appreciate your time today. If people want to find out more information about you guys, what's the best place for them to go? Maybe plug your blog. I go to your blog on a regular basis to get some information.
Certainly, there's great technology information out there on the RealPage website, which is just realpage.com. If you want to talk about some of the things that are happening in the marketplace, let's go realpage.com/analytics takes us to our blog, and we're putting out new information on what's happening in the market virtually every day.
Yeah, Greg's on various webinars, various webcasts, weekly at least.
I talk a lot, Michael.
So if you guys want to know what's going on in the middle of nowhere, North Carolina, Greg's going to be your guy, and he'll have a video shot every quarter probably on that. So, but in all seriousness, I appreciate you coming in today. It's Greg Willett from RealPage. I'm Michael Becker. I appreciate it. Thank you.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.